that's being recorded. So if you ask a question, that'll be on the BondSavvy site. So if you're not comfortable asking a question during the webcast, then just send me an email or give me a call after the Bondcast. Okay, so in terms of what we're seeing, and I wanted to give folks an idea of this because that'll help you understand the lens through which we were looking at these different investment opportunities. So the one thing that's important to know is, if you look at the bond universe today compared to 9 months ago, there are a lot more opportunities. There are a lot of folks who are, who may be averse to investing in an environment, where rates are potentially going up. But what that's created is a lot of opportunities that weren't around 9 months ago or a year ago. That being said, it's not as if there are 50 different opportunities. We were able to find a handful of new investment opportunities that we're sharing with you today. It's just important to understand that. If you look at the year so far, it's been really hard when it comes to capital appreciation. If you just look at the market in terms of how it's performing, the LQD ETF, which is the largest investment grade corporate bond ETF, it's down about 4% through May 30th. High yield's doing a little bit better. But what we believe is if you invest in individual bonds, you can react much better to how the market is creating new opportunities. For instance, we recommended a new bond, a Bed Bath & Beyond bond that was due in 2024 back on May 2nd, and that bond's up 6 points. So there are opportunities if you can be selective. What's important though is that you don't just want to take a big bang approach, in that there are new opportunities that present themselves throughout the year. It's not as if to say, all the opportunities are great right now, but there were some nice opportunities that we found today, and then we believe there will be more opportunities as the year goes on. So it's important to factor that into how you invest. The way that we're looking at different investments, we're generally favoring non-investment grade over investment grade right now. And the reason for that is that investment grade corporate bonds tend to be much more sensitive to interest rates than the non-investment grade corporate bonds. And the reason for that is that an investment grade corporate bond is benchmarked off the Treasury. So as the Treasury goes up and down in yields, that can have a direct impact on the price of the bond. Non-investment grade bonds, also known as high yield bonds, are generally less sensitive to rates. They're more sensitive to the credit quality of the bond. So what I'll say now is that there's greater interest rate risk than there's credit risk, and that's important to note. The last thing is that the yield curve is pretty flat, so there's not a lot of extra value for going out many years. And if you look at the recommendations that we've made thus far, 3 of the 4 recommendations are between 6 to 9 years in maturity. There's one that goes a little farther out, but just so folks have an understanding of that. Any questions in terms of the underlying environment, in terms of what we're seeing? Okay. All right, so let's move on to the new recommendations. And what we like to do is we like to give folks a variety of selection. In that, what we do is we do all of the analysis and all that work. So we narrow down the opportunities, and then it's up to the investor to decide, okay, from the 4 bonds that we're recommending today and for the nearly 20 that we've recommended thus far, which are the ones that make the most sense for you. And that holds true today in terms of the bonds that we're recommending. So we're recommending 4 different bonds, 4 different issuers, 4 different industries, and I'm just going to go through them really quickly because we'll get into the detail as the presentation goes on. So the first bond is Pitney Bowes. It's a mailing and shipping company. This bond pays a 4 5/8 coupon. It's due in 2024. An offer price of about 85.5, and a yield to maturity of 7.8%. L Brands, that is the company that owns Victoria's Secret and Bath and Body Works. That bond has a coupon of 6 7/8%, matures in 2035. Price in the low 90s, yields close to 8%. Then we have 2 other companies, Dish. Dish is obviously Dish Network, so that's the satellite television provider. Those bonds have gotten hit recently for a number of reasons, which we'll get into. That's the highest yielding bond that we're recommending, north of 10%. And the last, but certainly not least, Citrix Systems. IT company, and that would be what's perceived to be the highest credit quality company in terms of its ratios and in terms of its rating. That bond is priced about 98 cents on the dollar and yields 4.77%. So those are the bonds that we're going to be reviewing. We'll get into the details in a moment. But just so folks know, the way BondSavvy works is we make the recommendation today, but then we'll update that recommendation as the investment goes forward. So if there's a change in the company, if we believe that the bond is now a sell or we believe we should buy more, we will update that, and that'll either be through emails or through other conference calls that we have with subscribers. Okay, so moving onto slide 7. The buy-in price of corporate bonds is huge, and the way that corporate bonds work, and I've talked about this to a number of different audiences, that they trade in a range. It's not like when you buy a stock and it's hard to know what the highest price is and what the lowest price is, but you have a general idea from bonds, in that there's generally a floor and there's generally a ceiling. And what I've shown here is the pricing for all the bonds that we're recommending today and how those have trended over time. The good news is that we're generally buying all these bonds at all-time lows. These bonds have generally, if you look below the charts, we show the issue dates. So the Pitney bond, that's the one that's been outstanding for the longest. That bond was issued in March of 2014, and the other bonds were issued during 2016 or during 2017. So it's not as if we have 10 years of data, but you'll see that all these bonds, if you look at the Pitney bond, that was a bond that had a fairly tight range between 98 and 105. But then as we get into the specific story of Pitney Bowes, you'll see that there were some things that happened toward the end of last year that caused the bond to be downgraded, and as a result, the bond now trades in the mid-80s. And those are the type of opportunities that we're looking for, where perhaps there's been a downgrade, the price of the bond has gone down, but we still see there being an opportunity. And the same story holds true with L Brands and Dish, in that all three of those companies, Pitney Bowes, L Brands, and Dish, have had some operational issues, but we believe those are generally, at least for Pitney and for L Brands, those are short term. But it's created an interesting opportunity in the bond. And the last is Citrix Systems. So Citrix Systems, the business has performed well. It's just that since Citrix Systems is rated investment grade by one of the credit rating agencies, it's more sensitive to rates, and that's why you'll see that bond has fallen in price over the last, call it 7 months. The last thing I want to point out on this chart is think of these investments as as an investment that we're generally going to be holding between, call it 2 to 4 years, and it could be shorter, it could be longer, but that's generally the sweet spot in terms of how long it takes for a bond to, I'd say, go through its life cycle in terms of the trough and the peak. So think of it from that standpoint, and think of it when you invest. As I said before, it's not a big bang. It doesn't make, we generally don't believe that you just invest everything that you want today, but rather, if you like one of these bonds, make an investment today and then see how it performs, and then we'll make potentially more investments as time goes on. So it's important to understand that dynamic. Any questions on slide 7? Okay, so we're now going to move on to speaking about the individual issuers. And I'm going to go through the business of each company and how they're growing, some of the challenges that the companies have been facing, and then we'll end with the financial analysis. So you get a clear idea in terms of what the balance sheets of these companies look like, how the companies have been growing, what the cash flow is relative to its interest expense, all those different types of pieces of information. So let's start with Pitney Bowes on slide 8. All right. The way to think of Pitney Bowes is that they have a legacy business, and if you look at the right side of the table, right side of the page, you'll see that there are four main businesses, and the legacy business is the second item, which is the small to medium business. And that's a business that is very profitable, but it's shrinking. And where that business is on the left, if you go to the donut chart on the left, you'll see the international mailing business and North American mailing business. So that's a little bit north of $400 million of revenue of the total $983 million of revenue the company had in the first quarter. And that business is, if you think about it, Pitney Bowes manufactures mailing meters. And so if you're any company that's sending out the mail, you're processing that with a machine, and the Pitney Bowes machine does all that for you. And so it's figuring out how much postage it is. It's integrated with all sorts of applications, with your customer relations management applications, all different sorts of things, so that you're able to quickly send mail efficiently. And that's what that business is. Again, it's a high margin business, but obviously the mail business is not growing. But it's one of those things where they have this business, they've made some nice innovations there. It's a cash cow business. It's been around for 100 years, but it's not going to be the growth of the business. It's not going to be the growth of the company. The growth of the company is what they call this commerce services business, and that's made up of two different parts. And if you look at the donut chart on the left again, you'll see on the right side of that chart, there's what they call the global e-commerce business, which had $247 million of revenue in Q1, and the pre-sort services business. The pre-sort, just think of that as, I kind of lump that into the mailing business. They process and deliver 16 billion parcels for the United States Postal Service every year. So that's not really a growth business. It's the e-commerce business, which is shipping fulfillment and returns, and where they have partnerships with eBay and other e-commerce vendors where they've been making investments. And that's where they see their growth coming from. They did a large investment toward the latter part of last year, which is nearly a $500 million acquisition in this business, and that's where the focus is going to be. If you look at the other businesses, the production mail business, they just sold that. That was, again, a business that was a decent business, but in terms of where they're going forward, didn't really fit well. And the software solutions, if you think about the company, it's delivering 16 billion parcels of mail each year. It has this huge e-commerce company. It has all sorts of information in terms of where customers are located, the frequency at which customers are buying, returning, and they sell that as a software solution to retailers. It's not a large business, only $82 million of revenue last year, but that's the company in terms of how you should think about it. So moving onto slide 9, just to give you a little bit more color in terms of how they're thinking about these businesses going forward. So you've got the three businesses. So you've got commerce services, small to medium business, and then software solutions. And you get an idea in terms of how these businesses stack up to one another. So if you look at the middle part of this page, under 2017, it shows the revenue of each of the businesses. So the commerce services business had about $1 billion of revenue. Small to medium businesses had about $1.7 billion, and then software solutions was about $350 million. You see where the margins are. So you see that most of the profit, or the EBIT of the business, was coming from the small to medium business, which is the mailing business, and that had the 31% margins. But if you look over to the right and what they're projecting down the road, so this comes from the analyst presentation they just made a couple of months ago, that this business, the small to medium sized business, that they see it's going to be declining. So it's declining low single digits, both in terms of revenue and an EBIT, but it's still going to have the strong margins, the 30 to 35% margins. It's the commerce services business that they believe is going to grow. Right now there's not a high margin in that business, but this is technology that they build, and so it's a platform that they roll out to thousands of different customers, and it's scalable. So they're expecting that business has increased margins over time, growing from about 8% this year, growing to call it 12, 13% over the next few years. And they believe that business is going to be about half of their revenue over the next several years. So that's if you think about Pitney Bowes, this is not a growth company. If you look at the bottom box in terms of how this all rolls up, it's a mid-single digit type of revenue growth. It's low to mid-single digit in terms of EBIT growth, and a margin somewhere in the mid-teens. So that's this business. It's not the sexiest business, but when we look at the bond, you'll see that it's a compelling bond based on the risk return of this business. If you look at slide 10, so I've talked about how in previous presentations how we look at credit ratings, and when we look at a credit rating, we're focused on what can change, because if a credit rating goes up or down, that's going to have an impact on the price of the bond, whether we like it or not. Because most people, when they invest in bonds, they're reactionary. So if there's a downgrade, they sell it. If there's an upgrade, they buy it. Now, both S&P and Moody's recently downgraded the bond. And the reason for that is I mentioned before that Pitney Bowes did a large acquisition last year. So they bought a company called Nugistics for $475 million, and that's part of their e-commerce strategy. So shipping fulfillment, shipping returns, all the logistics around that. There's not a lot of cash flow that goes with that business. So what happened was they incurred a lot of debt to buy this business, but there wasn't a lot of cash flow that went with it, and as a result, the overall credit quality of the business was hurt in the near term, and that's why S&P and Moody's downgraded the business, downgraded the company. That being said, since they sold that production mail business, they're going to pay down between $500 to $700 million of debt in 2018, and I'll show you that all the details of that in a moment. The other thing I think of when it comes to Pitney Bowes, and this is in the business momentum area, is that if you go back a number of years ago, and you looked at the markets that these guys were in, the markets weren't growing. The markets were projected to decline about 2% a year. Now they're in, the e-commerce market is expected to grow significantly. We all know the growth of Amazon and folks such as that. They're now in growth markets, and now it's where 40% of their revenue is within a market that's growing. So again, this is not a company that's going to turn on a dime, but the fact that they're positioning themselves in that way, I believe, bodes well for the company in the future. The last part is that they cut out about $300 million of expense over the last couple of years, and so they've cut expenses. They've started to grow revenue. They're getting into growth markets. They're paying down debt. When you take all that together, I believe that that's an overall good story for the company. And last on Pitney Bowes on slide 11, these are the upcoming debt maturities, and you'll see. So if you look at the chart on the left, these are the maturities that they have every year. So in 2018, they've already paid back $250 million. That's what they had due. 2019, that debt is already spoken for because they're going to be repatriating $500 million of cash. They have $270 million of proceeds coming from the sale of the company that I talked about, and they're going to have more free cash flow as the company moves forward. So 2019, they already have that effectively covered, and they've already started to make it. They'll start making a dent in 2020. And so when I look at this business, the fact that they've already paid down their debt maturities in 2018, 2019 spoken for, 2020 they're starting to get in a good position. That's how I can feel comfortable investing in this bond. Any questions on Pitney Bowes? Okay. All right. So let's move on to slide 12. And this is L Brands, used to be called Limited Brands. It's as I mentioned before, it's Victoria's Secret and Bath and Body Works. If we look at the chart on the left, that just shows the distribution of revenue by business, and you'll then see on the right how these businesses have been growing. And if you look at the left, you'll see Victoria's Secret, the stores. That's obviously, you go to the mall, you see, Victoria's Secret stores. That's all that is. That's about 50% of the revenue. So that was $5.9 billion of the company's $12.6 billion of 2017 revenue. The direct was $1.5 billion of revenue, or 12%. Now, the other big business is the Bath and Body Works, and that's a smaller portion of revenue. However, that's a more profitable business. So if you look at the operating income from Victoria's Secret versus Bath and Body Works, it's about 50-50. And if you look on the right side, you'll see how these businesses have been growing. You'll see Victoria's Secret stores. Those have been struggling, and we'll get into a moment as to what's been causing that. But the revenue's been down 5%, both total and in terms of comparable stores. Victoria's Secret Direct hasn't done anything great either. But Bath and Body Works has been strong, and it's not as if Bath and Body Works is a small business. There are more Bath and Body Works stores, 1,700, than there are Victoria's Secret stores. But it's grown nicely over the last year, 6%. The direct business, so the online business, has grown very well. And so when I look at this company overall, I see that every business, so Bath and Body Works, you then have the international businesses, you then have these smaller businesses. Mass Global, I'd say keep out of the side. That's their logistics business and supply chain business. But La Senza's intimate apparel, and Henri Mandel is another retailer. Those businesses are all doing well. So it's a generally healthy company. It's just that there's been some hiccups at Victoria's Secret, and we're going to get into those. We're going to get into those in a moment. But just want folks to get an idea in terms of where the revenue is generated, what's been growing, and what has not been growing. So on slide 13, I'm going to start with the business momentum. If you go back a few years, the company decided to make some changes at Victoria's Secret. And so it decided to exit the swim and apparel business, which was about $525 million of revenue, and to stop the catalog business. And I never thought I'd say this in a presentation, to reduce their direct mail bra and panty promos. So all those things together did a number of things. So it obviously reduced revenue, and it hurt store traffic. And it hurt store traffic. As a result, it hurt comparable sales. And as a result, when people look at this business, they start to get concerned because the Victoria's Secret business is still 60% of the revenues. So just so folks have a little bit of context for that. That all being said, this year for the company overall, they're projecting reasonably strong sales growth of about 5% for primarily bricks and mortar retailer. That's pretty good. They're projecting $800 million of free cash flow, so they're going to have money to pay down debt. When we look at the top in terms of the ratings momentum, again, we're trying to find bonds that have the opportunity to be upgraded. And I'll show you in a moment where Victoria's Secret is rated, or where L Brands is rated, but it's one notch below investment grade. Now, for it to be upgraded, the Victoria's Secret business is going to have to perform well, because it's still the largest business. It's still having some operational issues. So even if the leverage of the business is low, meaning its debt to EBITDA is low, the analysts at S&P and Moody's won't change their rating until they see a better turnaround with the Victoria's Secret business. So I don't see there being any great chance of an upgrade or a downgrade in the near term, but I'm hopeful that over the next couple of years, there is an opportunity to be investment grade. Is an opportunity for the company to be investment grade should Victoria's Secret start seeing some fruit of the turnaround. Any questions on L Brands? Okay. All right, moving on to Dish. Okay, so Dish is a company I know well. My background is, I was for a large part of my career an investment banker in the media and communications industry. I was recently with a company called Tribune Media Company, which is a television broadcasting company. So this sector I know very well. If you think about the position that Dish is in, and I just wanted to draw the distinction for you between Dish DBS Corp and Dish Network. Okay, so Dish Network is the parent company. The bonds that we're talking about are owned by an entity called Dish DBS Corp. That's where all the debt is. That's where all the that's the operating entity of the business. So they effectively take the cash flows from the Dish TV business and use it to pay off the debt that's held at Dish DBS Corp. Now, one thing that's important to keep in mind is that Charlie Ergen is a well-known CEO. He controls the company. He's been aggressively buying wireless spectrum to the tune of $10 billion. And that wireless spectrum is held at the parent company, Dish Network. So what he's effectively done is he's taken the cash flows from Dish DBS as well as the debt at Dish DBS and used that to buy this wireless spectrum. But the wireless spectrum is held at the parent company, and as they build that business out, it's not within Dish DBS Corp. It's at the parent company. So it's a distinction that folks should be aware of. That all being said, what they're looking to do is they're looking to build out a wireless network. They've been sort of loosey-goosey with exactly what they're doing, other than that it's going to be this 5G network that can do lots of interesting things as it relates to mobility and streaming and all those things with regard to entertainment. But right now it's been effectively a cash drain on the overall company. So just so folks know what that all means. More importantly, if you look at Dish and its business, so like any satellite and cable company, if you look at the gray bar in the chart on slide 14, you'll see that in 2015, the company had 13.3 million Dish TV subscribers. So those are the folks. So if you're a Dish customer, you're paying $150 a month or whatever you're paying for satellite and some other odds and ends, that's those customers. They then have their Sling TV. So that's their over-the-top offering. You'll see that it's a smaller number of customers. So it was 600,000 customers at the end of 2015. And you'll see that the traditional Dish TV subscribers have been falling down to 10.8 million at the end of the first quarter of 2018. And and the Sling TV customers have been going up. Now, the issue with that is that the ARPU, so that ARPU is just average revenue per unit, so that's what they're getting per subscriber per month. That is a lot lower for the Sling TV subscriber. So it might be $20 a month, $25 a month, compared to something a lot higher, called $100 a month for the traditional Dish TV subscribers. And that's why you'll see the ARPU has been relatively, it's been flat. It was $86.79 in 2015. It's now about $84.50. And the reason for that is that you have more subscribers who are Sling TV subscribers. That's what's been growing. They're at a lower ARPU. That's what's hurt that part of the operating metrics. But just so folks know, it's not as if yes, customers have fallen 20%, but if you look at the right-hand side, you'll see that revenue has fallen. It was $14.8 billion in 2015, down to $14 billion in 2017. You'll see EBITDA, the company's cash flow, has fallen. It was $3 billion down to $2.7 billion. One of the good things is that churn. So that's the number of customers who leave every month. That's been relatively flat, and actually in Q1 it was at a 4-year low. It was about 1.47%. So the thing folks need to ask themselves is, do you believe that the trend is flattening, or it's going to get much worse? I believe that they're going to continue to lose subscribers, but if you look at how they've lost subscribers, they lost, if you go over to the left-hand side, they lost 1.1 million subscribers between 2015 and 2016. They lost 1.2 million between 2016 and 2017, and starting to slow a little bit in 2018. So 2018 is going to be a really important year in terms of where this business goes. But it's just important to know that this obviously, it's not a growth business, but it's still a highly profitable business. Okay, onto the momentum on slide 15. So we talked about how the ARPU has been trending. We talked about how Sling TV has been a bright spot in their business. Now, the other thing that it does with Sling TV is that they have direct ad sales. So if you think about how a traditional cable company works, they have, most of their revenue is generated from their subscription fees. But if you think about how Sling TV works, they're not only charging a subscription fee, but then they're also charging advertising sales. So, if you have Sling TV, you'll see some ads, and Sling TV will be selling those ads and generating revenue from that. Now, they do not break out the revenue between ad sales and subscription revenue for Sling TV, but it's been growing. And so that, what I'm not sure of is how fast that revenue can grow, because they don't split it out. What I believe is that revenue is going to continue to grow. The revenue from the traditional TV business is going to continue to fall, but as we'll show on a little bit later, given where the company is positioned, they're still going to be able to pay off their debt, and that's obviously what we have to worry about. If you look at the top part of this slide on the ratings, so they just got downgraded, because they've been, the ratings agencies have been focused on what's been going on with subscribers. Subscriber numbers have been falling, but on the positive side, they did pay down about $1 billion of debt earlier this year, and Fitch upgraded the specific issue level bonds one notch. Now, the overall Dish DBS rating still got downgraded by the other folks, but at least it's a somewhat positive thing that they did, and that they paid down some debt. But as you'll see in a moment, as we get into the specific financials, this is a company that has significant bond maturities coming due over the next 8 to 10 years. Every year it's about $1 billion+. Any questions on Dish? Okay. All right. So the last bond that we're going to review is Citrix Systems. So the way to think of Citrix Systems is, if you think about the old way that IT worked, this is on slide 16. So you'd have locally installed Windows applications. So you'd have your IT guy come in and he'd do all sorts of work on your computer, and then then you had to go and do the same thing for 500 other folks at your company. Citrix works differently in that everything is held centrally. So if the company, let's just say it's, company ABC has 1,000 employees, it will decide which applications it wants those employees to access, how it wants them to be able to access them, and it stores all that centrally, either on the cloud or in a data center, and it then controls the access to those different applications. And this business is called their workspace services business, and that's what generates about 60% of the revenue of the business. So when you think about Citrix, that's the core. It's the core of their business. If you look at slide 17, so the company has 3 different businesses. So there's the workspace services business that I talked about before. That's called, fancy term, app virtualization product. So it effectively virtualizes or puts in a central area, whether it be on the cloud or in a data center, all the different apps that you need to use. And that product is called Zen Desktop and Zen App. They also have solutions for mobile called Zen Mobile. They then have their networking business, which effectively ensures security and speed and reliability for applications that customers develop. They also have a file sharing business called Content Collaboration. You'll see that the revenue breakout on the bottom left is still about about 60% toward workplace solutions, and then a less amount in networking and content collaboration. About a similar type of story, 60% of the revenue coming from the Americas, and the rest of the world, tilted toward EMEA, Europe, Middle East, and Africa. In terms of the trends of the business, so if you look at the bottom part, the business has performed well. So these are, revenue. Again, it's a company that's been around for a while, so it's not going to be growing 25%, but the revenue growth was reasonably solid. The workspace business grew about 3% compared to 8% for the networking business. That's generally because the workspace business is growing off a bigger base, so it's obviously harder to grow it at significant portions. They've been very cost conscious in that they've increased their operating margins by about 4 percentage points, and they've had some strong momentum on the sales side. So all in all, the business has been performing well. When you look at the ratings on the top part of this, so the company is what's called a split rated company, and what that means is that it's rated investment grade by one, so it's rated investment grade by S&P, and then it's rated below investment grade by Moody's. And the reason why Moody's rates it below investment grade is that the company's done about $4 billion worth of buybacks over the last several years, so that's limited the amount that they have to pay down debt. And there's an activist investor in there, and so they didn't like that. But when you look at the actual company, it's a really strong company. It should be investment grade. The one thing that's interesting is that the company has about $2.1 billion of debt, of which about $1.4 billion is in a convertible note. And that convertible is what's called in the money. And I don't want to lose people on this, but all that it means is that people can convert from the bond to the stock. And if the price of the stock is higher than the conversion price of the bond, they can do that. And right now, the convertible is what's called in the money. So the stock price is higher than the conversion price. So it could be the case that people could convert and the $1.4 billion of debt goes away, and you're left with a company that only has about $750 million of debt. And that's a company that has leverage of less than 1 time. So, that's something that doesn't appear to be factored in that heavily by the rating agencies, but that's something where if that were to happen, you then have an extremely high credit quality company, one that could be upgraded even to where it is now. Any questions specific to Citrix before we get into the financial analysis? Okay. All right. So now I'm going to talk about how these bonds stack up with one another, just so from an overall financial perspective. And I'm on slide 19. And so I've already talked about the different bonds. And so if you look at slide 19, the information that is shown there is the information that we've shown before. So it shows the bond, it shows the price, the yield, that sort of information. Now, just so folks know, right underneath the bond is the CUSIP. That's the 9-digit identifier. So if you go into whatever trading system you use, you would just enter the CUSIP and you're able to buy the bond. The prices are quoted as of yesterday, as of about 10:30 a.m. yesterday, so the prices could go up or down. These were prices that were quoted on Fidelity. Offer price we talked about. The spread to Treasury, all that's saying is that if you look at this Pitney Bowes bond that's due March 15th of 2024, so there's a Treasury bond that's due right around that same time, and the spread of the Treasury is just the difference between this 7.79%, which is what the Pitney Bowes bond is yielding, and the spread and the yield of that Treasury that's due right around March 15th of 2024. So it's showing you the extra compensation you're receiving for the credit risk of Pitney Bowes. If you compare that to the other bonds that we're looking at, so it's saying that, okay, Pitney Bowes and L Brands, they're very similar in terms of the spread to the Treasury and what you're being compensated. Dish is the highest, so Dish is about 7.5%, and Citrix is the lowest, about 1.93%. And the reason for that is that if you move over to the right and you look at the credit ratio, so this is the bread and butter of the analysis that we do. Leverage is just company's total debt divided by its cash flow or its EBITDA. Interest coverage is the company's EBITDA divided by its interest expense. Tells you how much money it has coming in to cover its interest payments. And you'll see that if you look at Dish, it has 5 times leverage and 3.2 times coverage. So that's the worst compared to all these different companies. Citrix is the best. So Citrix is leverage of 2 times and interest coverage of 13 times. So it's a more secure investment than say Dish. And you're being compensated that for Dish. So you're being compensated, a yield to maturity of 10.3% compared to a yield to maturity of 4.8% for Citrix. When you look at the growth of these different companies, so you'll see most of these companies, again, these aren't growth companies. I mean, even Citrix last year, when you look at the growth of the company, it only grew revenues 3% and it grew EBITDA about 2%. So it's important to know that these are not companies that are growing like a weed, and that's why there are opportunities in these different bonds. That all being said, if you go all the way over to the right and you look at the margins, these are reasonably profitable companies. You've got companies that have EBITDA margins either in the high teens or in the mid-30s in Citrix's case. One last thing to keep in mind on this slide is, we don't just look at if you look at the left side, you'll see this offer price yield to maturity. We don't just look at that as our return. Again, we're looking to buy bonds at a discount. That's why these bonds are trading. If you look at Dish, it's trading at 86 cents on the dollar. And we believe that that's a bond that can appreciate in value as the company hopefully performs, as it pays down debt. Moving on to the last slide on slide 20. This just gives you a little bit more perspective in terms of the different bonds, and you'll see that the information on the left half of the slide, that's the same information that we showed before, but then we complement that with other information that shows, okay, how much debt does the company have on its books? How much cash does it have? So if you look at, let's say you look at Citrix down at the bottom, and you see it has $2.1 billion of debt and $2.2 billion of cash. It has capacity of $250 million. And it has this upcoming maturity of $1.4 billion. That was the convertible note that I talked about before, which could convert to stock, and they may not even have to pay that out of cash. So it's a company that has more cash than it has debt. And you'll remember from the previous slide, the company has $1 billion of EBITDA. So that's a company that, given its cash on the balance sheet, given its cash flow, given its low debt balance, that's how you can be comfortable with an investment such as this. The yield is 5%, but again, this is a bond that's priced around 98. I'd love it if it was at more of a discount. It just traded up the last couple of days, but this is a bond that I believe, let's say that they retire this convertible note, then you have a much stronger credit quality issuer that could be upgraded, and that's where you could see a nice price appreciation. You look at Dish, that's where, yes, you have $836 million of cash on the balance sheet, but you've got some significant maturities coming up. Now, they already paid down the debt that's due in 2018, but in 2019, they have $1.4 billion of debt. They have $1.1 billion of debt that's due in 2020 and $2.2 billion of debt that's due in 2021. So, that's the case where they'll pay down some of that debt with cash flow. They'll pay down some of that debt with cash from the balance sheet, but they'll likely have to roll over and refinance some of those bonds. One important thing when it comes to Dish is that there is no senior debt. So you'll see that there's no credit facility at Dish. And all that means is that all the bonds are on the same level, also known as pari passu. So, if there was, let's say there was an issue with the company, it's not as if that there's all sorts of claims in front of us as bondholders. We're at the same level as the other bondholders who own, the $13 billion of debt at the company. So it's important for folks to know that there's not there isn't a senior bondholder that would come before us. L Brands is a little bit different in that L Brands still has $1 billion of cash on its balance sheet. It does have a senior credit facility, but its maturities aren't as significant as Dish's. So you have $398 million coming due in 2020 and about $1 billion each in 2021 and 2022. So that's a case where we can hold the bond the next couple of years and then see what position the company's in a couple of years and decide, okay, do we want to keep holding this bond, or do we feel, we're not that comfortable in the company, or there's been capital appreciation with our investment and we want to sell it. So those are all the different considerations as we think about these bonds. Any questions on the analysis of the last couple of slides? Okay. All right. So last thing before we get into Q&A, if you enjoyed the Bondcast today, obviously tell folks, or hopefully many folks, about BondSavvy. If you're active on social media, we make regular postings on Facebook and LinkedIn and Twitter. I'd love it if you can make a review or share a post that we make. It definitely helps get the word out. And with that, I will turn it over to other Q&A.
Yeah, okay, so these bonds are selling at a discount, presumably because of credit risk. And that's basically the risk that they would ever default on any of their payments. And I guess I have to ask, what's the likelihood of that? I know the ratings are sort of a guideline as to what the likelihood of that might be. But I'm sort of wondering how often that happens. Not being a bond savvy guy, not being somebody who's familiar with bonds. What kinds of things would happen that would cause them to default? Yeah.
So just a couple of things to keep in mind. So the default rates for non-investment grade bonds in 2018 are projected to be somewhere between 2 to 3.5%. Okay, so it's generally it's generally an outcome that does not happen. The most important thing is a couple of things. So first is what upcoming maturities. Let's just step back. So first is, can they pay the interest? And I'm back on slide 20. When you look at the interest coverage of these bonds, so they have substantial cash flow to cover the interest expense of the bonds. So I'm generally not worried about it from that standpoint, because even if these companies have a downturn, they're still able to pay the interest. The next question is still on slide 20 on the right side, is can they pay down the maturities that are coming up? And that's where there's different risk associated with the different bonds. So if you look at something such as Pitney Bowes, that's a company that in 2019, it already has accounted for that. It's already committed to pay $500 million of debt in 2018, plus it's going to pay more down through the sale that it had. So you look at the upcoming maturities. You then also have to look at these things that are called financial covenants, in that a bond issuer has to maintain compliance with different financial covenants, which are effectively the rules of the road. So when the company issues bonds, it's not like a stock where, if you issue stock in a company, you don't have to pay a dividend if you don't want to. You don't have to pay people back. You don't have to, there are no rules of the road other than basics. Bonds, it's very different in that there are certain things you can and cannot do. You cannot have debt that's above a certain level. You can't make payments. You can't pay certain dividends. You can't make payments to different subsidiaries, all different sorts of things that restrict what you can and cannot do so that it's safe to own the bond. The covenant compliance of these bonds that I'm recommending is all generally strong. So the way to think of it is that the Citrix Systems bond, that's an investment grade bond, that obviously has the lowest risk of default. I'm not telling you anything new there. When you look at the others, it's the DISH bond that has the most principal payments that are coming up. That would be the highest risk. But they're extremely active in the capital markets. If they don't have the cash or the cash flow to pay off the bonds, they would generally be able to access the capital markets and then refinance the bonds. That's typically how the world works within corporate bonds. Does that answer your question?
That helps, sure.
Steve, I have a question. I heard you say that you do not recommend a big bang approach to investing in bonds. But can I build a portfolio by investing in bonds that you had recommended in the recent past, assuming that they are still trading at a discount?
Yeah. So that's a great question. So if you go and you log into BondSavvy, the first thing that you'll see is a list of all of our recommendations, and the recommendations that are there are all bonds that that we still continue to recommend. So you can go and you can look at those bonds and construct a portfolio from not only the bonds that we recommended today, but those other bonds that are on that recommended list. You make a good point in terms of, I show the price at which we recommended the bond. So that's what you'll see. And obviously, if we recommended the bond at 95 and it's now trading at 92, you're getting an even better deal. The one thing that's important is that you'll see. I did an analysis yesterday, and just to get an idea in terms of where some of the bonds have moved, and you'll see some cases where a bond such as the Bed Bath of 24 bond has moved up very nicely, but then a bond such as the Apple of 45 bond has come down about 5 points, and that's where when I look at a bond such as that, you certainly now have a more compelling yield. The challenge with a bond such as Apple is that it's a longer dated bond, it's more sensitive to rates, but I like to have those sorts of bonds in my portfolio because those bonds can, if let's say there's a recession in a couple of years, those bonds can perform very well, and anytime you can buy a bond such as Apple that yields 4%, it's generally a compelling buy. So yes, you can use those recommendations. I just got a question online about where to access the bond price charts. So if you go to the website investinginbonds.com, and there's a link there to FINRA market data. If you click on that link, you'll then go to a screen that'll show bond pricing information, and then you just go ahead and enter the issuer or the CUSIP. If you can't get to it, just email me at steve@bondsavvy.com and I'll send you the link.
So Steve, do you recommend a dollar cost averaging approach to these, and say buying a third, then waiting a few months, a third, then another third, or what's your comment?
Yeah, so I would say what I'm going to do, I'm just speaking personally, is I'll go out and I'll make an investment today, and let's say that, and the thing is that you can't necessarily say like a third, because what'll happen is let's say that we make an investment today, and we then look at it in a few months, and things have changed. So it could be where we decide to invest more heavily in one bond versus the other, and that's something that we'll update on. So I would say, generally, if you let's just say that you want to allocate a certain amount, right? I'm not going to give a specific percentage, but when if I'm personally thinking that I'm going to invest, say, 25 bonds for one issue, maybe I'll buy 10 today, and then I'll get an idea in terms of over the next, call it 3, 6, 9 months, whether I want to invest more in that bond or more in other bonds. And it's really important to be flexible, because when I make the recommendations, I'm not necessarily calling a bottom. I'm saying that based on the pricing today, that these are compelling values. And it could be that, you know, some of these bonds can go down in price. So I do advocate dollar cost averaging. You know, I won't give a specific percentage, but I give a general sense in terms of how I approach that. And you know, each investor will need to decide for him or herself. You know, you might say, okay, you know, when I look at the Dish bond, you know, it's at an all-time low. You know, maybe that's something you want to be more aggressive with. You know, each investor will need to make that decision on his own, his or her own.
Right. Correct. So if we buy the bond and then we see it go down 3%, is that when we should pull the trigger again? Is that what you would do?
You know, I would. So for the Bed Bath bond that we recommended way back when, so there's a Bed Bath of 44 bond. So you know, we made the recommendation, and then I kept following the bond. It wasn't that if it fell a specific percent, I would generally make the investment, and then, you know, if it falls a point, I'm not going to necessarily buy more bonds. But if it falls, you know, a 3-point fall is a material fall. So that's something where, and especially if you get an idea in terms of how what the pricing range of certain bonds is. So if it's an 8-year bond and it falls 3 points, that's a pretty material decrease in the price. If it's a 20-year bond and it falls 3 points, that may not be that huge of a deal. Any other questions? Very good. Well, thanks so much for joining, everybody. If there are any follow-up questions, either email me. You can email me at steve@bondsavvy.com. You can call me 201-748-9862. And our next edition of the Bondcast, what we typically do is we have 5 editions of the Bondcast throughout the year. That's when we make 4 recommendations. You'll notice that on May 2nd, we made another set of recommendations. That was because there was a unique opportunity in those particular bonds. We typically line up the timing of the Bondcast with earnings releases. So think about it, the next earnings cycle is, you know, for June 30th. You know, companies have 45 days to report. So that takes you into August. That's likely when it'll be. But, you know, as bonds move, we might have an update in between then. I mean, we'll certainly, if there are updates, we'll send out email updates. If there's something very important, then we'll have another call for folks. But that's generally how we work through things. But thanks so much for joining, and look forward to talking to everybody again soon.
Thank you, Steve.
Yep, you're welcome.